Welcome to the African Stack, where we're having conversations with the people building the systems shaping Africa's digital future. Today, we have with us Rockfella, who is our expert in all things fintech, in the banking systems that are happening around Africa, and in the systems that are building, everything around that goes around that area. So, Rockfella, first of all, welcome to the podcast. We are so happy to have you here today. Why don't you give us a little bit of an introduction? Tell us who you are, what you work in, and what your background is in.
Thank you. I'm glad to be a part of this, and thank you for allowing me to be a part of this conversation. Rockfella Chenenje is my name. I am a Kenyan, a son of this African soil, and by profession, I am a techpreneur.
Okay.
But at the same time, academically, I'm a computer scientist. And for the past 7 to 8 years, I have been working at the intersection between finance and technology. So I do what excites me because I do believe that that's where I belong. And I'm glad to see what is happening both locally and across the continent in that respect. In terms of what I'm doing exactly at the moment, I serve as a chief executive officer of a Kenya-based tech company. We are building nice solutions that are meant to sit in between finance and technology, to be specific, to make work easier for entities to comply to regulations, and at the same time to make it easier for supervisors and regulators to carry out their mandate as per the legal and regulatory framework across the continent.
Mm-hmm. So you've said you've worked in this field, in that intersection for a while. What would you say has changed in between when you started and where it is now? What has changed in the fintech world?
Many years back, let me say around 7 to 8 years back, there was a bit of hesitance by institutions to adopt the new technologies. And I should say that most entities happened to be risk averse at that time. But over time, especially within the past 5 years, with the wake of COVID-19 that forced many operations to become paperless, we've had many financial entities embracing new technologies. To be specific, we have AI, and also to adopt advanced cybersecurity measures. And therefore, it has been a very impressive journey and progress across the industry. And as we speak today, to be specific to Kenya as a country, we are doing way better compared to other jurisdictions across the continent.
Are we doing way better in terms of like the legal side of it, that we're just adapting more and having more policies that are around that? Or are we adopting better in terms of the technology that we're using and developing?
I should say both, because first of all, the efficiency and the integrity and stability of any country's financial system is dependent, first of all, on how strong and robust the legal and regulatory framework is. And as a country, we have been on the forefront of putting in place policies, regulations, laws, and guidelines to make it easier for entities to comply and to be able to ensure that we are on the forefront of taking care of the new trends we are seeing within the financial sector. But at the same time, the regulators haven't been left behind, because having developed the legal framework, they have gone an extra mile to position themselves adequately to be able to regulate and to supervise efficiently. And because of that, most of them have adopted digital tools to make work easier and to optimize efficiency as well.
So what kind of digital tools are these?
We have a unique space within tech called RegTech.
RegTech.
That is regulatory technology, and SupTech, that stands for supervisory technology. It is a very niche area, but we've heard of InsurTech, we're talking about insurance. We've heard about FinTech, talking about finance and technology, and many others. But this is a very unique area where we have regulators adopting technological tools to enable them efficiently carry out their mandate of supervising entities but at the same time, we have entities being able to comply efficiently using the same tools. Because among the largest problems that new companies have been having locally and across the continent has been how to manage the cost of compliance. Because many times, different jurisdictions do have got different expectations as per their legal frameworks. It becomes so difficult for a new company or a startup, to be specific, to be able to comply fast enough and within the expectations of the market they would want to launch into. So by adopting these tools, both by regulatory entities and also by entities that are meant to be complying, it makes the work for both easier.
Okay, that's interesting because that's the first time that I've heard about these different kinds of tech, because we just hear about fintech and all that kind of stuff. I want us to go a little bit deeper into this. I want to get a better understanding of what it is. When you say like regulatory technology and all that kind of stuff, are you talking about the things that create the laws, or what kind of technology is this exactly that we are talking about?
Yeah, first of all, just to give you a background of how it happens, any regulator within the financial sector has got two primary roles to play within the financial system. And the first one is what is called the stability, maintaining the stability and integrity of the financial system, to ensure that all the entities that are playing within that space are complying to the law and are protecting the hard and savings, if there are to be banks, that are there that have been saved by the customers. But at the same time, we equally have what is called consumer protection, meaning that the rights of each and every consumer within that space has to be protected and has to be addressed. So those are the two major expectations that any government has of any regulator or supervisor. So the first bit of managing the integrity of the financial system is called the prudential expectations. But of course, the second bit that is focused on protecting the consumer is generally called consumer protection.
Okay.
So when the laws are being drafted, at the back of the mind of these drafters is how can we ensure that the financial system is stable, and at the same time, how can we ensure that the consumers of the goods and services being served by these players are equally protected and all their rights are well taken care of. So once the laws, guidelines, policies, regulations have been put together, the whole of this set is what you're referring to as the legal and regulatory framework. But now, once you have it on paper, the difficult part comes in at the implementation level. How can you be able to ensure that the entities that are being regulated are able to do so efficiently? And so that's why we have a group of startups that have put together tools that are meant to make work easier for both the regulator to perform their task of managing the market, but at the same time, the regulated entities to be able to comply without having a difficulty in doing so. So that is majorly the main goal of SupTech and RegTech solutions.
Wow, there's so much that goes into that. So is that what the regulatory sandbox is?
That is part of SupTech and RegTech.
Okay.
Because part of a regulator's mandate is to first of all assess the competency of an entity before you allow them into operation. So you first of all have to analyze their capabilities and their capacity to comply to the legal framework before you can allow them to start operating. So the regulatory sandbox is a controlled digital environment within which a new entity seeking a license can deploy some of the products that they would want to offer their customers. So once they have deployed that solution, you as a regulator are able to monitor and analyze the operation of that product within a specific time period. At the end of that period, you're able to tell whether, as per the parameters you have, that product or set of products are able to meet that threshold or not. So based on your assessment at the end of that period, you're able to advise the entity seeking a license on whether they should continue with the product because it does qualify, or whether there is need to make adjustments for it to qualify. But we have cases where you just have to reject the whole product in totality.
What are those cases like? What makes you reject a whole case?
Okay, as per the law, we have what are considered gross or unacceptable attributes of a product. Let me give you an example because we are specific on the financial sector. Me, as a startup, offering what is called a digital loan or digital credit. As per Kenya's law, we are calling them the non-deposit taking credit providers. Previously, they used to be called digital credit providers. So they want to offer a new digital loan. But as per the Kenyan law, we have what is called the law that, let me not go into this, but we have the law that controls the maximum amount of interest that you can charge on a specific digital loan. But as per the threshold that the specific entity has given you regarding the interest attribute of that loan, they won't be able to make reasonable profit not unless they charge it at a specific interest rate. However, that interest rate happens to be way above the threshold allowed by the law. So the agreement has to be they either modify the interest attribute of that product, or if they're not willing to do that, you as a regulator, you have a mandate to protect the consumer. And in this context, the best you can do is to reject that product in totality, but having given it adequate time within the regulatory sandbox and observed how it performs.
So is interest the number one reason why things would be considered like a no-go, or are there other deeper reasons?
There are many aspects to what might amount to a product that might be rejected. But of course, if I might be specific to the financial sector, any financial entity in this country falls within either of these four categories. Number one, you are either providing a capability to save or to store value. At the same time, you are either providing a capability to transfer value or what we call payments and remittances. Then you are also providing the capability for your customers to invest or to augment value on what they have stored. And lastly, you are providing value to your client by issuing them credit and then paying you back with an interest margin on top of it. So if you look at this wider context of financial products that we have within this country, we have parameters that regulators use to be able to tell whether this product qualifies to be released to the masses or not. So based on those thresholds, interest being one of them, then you're able to tell whether by us allowing this product to become operational, we might be infringing on the rights of the consumers or not. So at the end of the day, what determines the capacity of a product to be allowed into production is the conversation that occurs between the regulator and the entity seeking a license for that product. So the two of them have to meet each other halfway, as long as the eventual agreement falls within the provisions of Kenya's legal and regulatory environment or framework.
Okay, so still on this topic of assessing the competencies of the systems, because you mentioned that earlier. In your experience with like banking systems and financial systems that you've worked for, what are the critical systems that must, like, absolutely must work correctly every second for the financial institutions to be able to function?
Every bank has a critical system called the core banking system. And what this system primarily does, it is the master database of all the customer records that a bank has. And at the same time, it manages all the customer transactions, be they payments, be they getting of credit or transfer of funds to other bank accounts, or even investments. All those transaction records are managed by the core banking system. And at the same time, the core banking system does not work in isolation. It works through integration to other third-party systems. Let me say of a system that is responsible for management of loans, that can be an independent system, has to be integrated to the core banking system. You have a system that manages investments, it has to be integrated with the core banking system. But at the end of the day, the system that manages the core database of all the customers that you have is the core banking system. Then it can be integrated to all the other systems that you need to be able to successfully offer your products to your customers.
So these other systems that you're integrating, are they being outsourced or are they also coming from the bank itself?
Most banks prefer getting these systems from third parties.
Okay.
The reason being, you as a bank, you want to focus on the business of directly managing your customers and interacting with your customers on a day-to-day basis. Therefore, the amount of investment technologically to have your in-house team that will be able to build each and every system might not be feasible. So the best thing to do is to identify within the global IT space the best providers of such systems, be they systems at the application layer or systems at the customer-facing layer or systems at the data management layer. Then at the end of the day, once you've identified them, then you can have long-term partnerships or agreements with them to have them offer you solutions. They could be on-premise, it could be through a hybrid arrangement or purely on cloud, as long as you're able to address all the needs and expectations of your customers. However, we have cases where we have banks that have built adequate capacity locally to be able to take care of lighter systems where you can build them within the house and integrate it with the core banking system. However, the chances that we have a local bank that can come up with a core banking system end to end is a very massive undertaking that might not be feasible for most banks.
Why isn't that feasible? And because you've brought about the aspect of global versus local, why do companies choose more global routes for this than local routes? And is there, what's basically what I'm trying to ask is what's wrong with the local routes? Are they available or are they just insecure? Or like, why don't they work?
The main issue at play here is the bank wants to stick to its lane, and its work is to handle money for its customers and to create value on top of that money stored for its customers. Yet we have a different set of tech companies that have specialized for many decades in the space of designing, developing, and managing systems that are meant to support banks do their work. So it is more or less a separation of concerns. My work is to build systems to help you do your work. Your work is to use the systems to support your customers. So at the end of the day, the bank isn't able to spread itself too thin by trying to do everything. So we just want to focus primarily on using a system that has been created by somebody else to do your work, which is to create value for your customers and allow a different third-party entity to do its work. Now, comparing local versus global entities, the truth is that most of the companies we could be having local might not have been in existence for that long to have been able to build adequate capacity to create such massive systems. And that's why we have companies that have been in existence for more than 4 or even 5 decades in other jurisdictions where they were supported by the government back then. And they have, over the years, been able to build a lot of capacity to be able to churn out systems more efficiently and cost efficiently. So the chances that we can have local entities being able to compete with them are very low. But even so, what I've seen is that of late, in the past few years within Kenya's IT space, we've had so many tech companies trying to build as much capacity as possible. But most of them prefer to do so in partnership with other foreign entities as they transfer knowledge and skills. And I believe that in the next few years or so, we are going to have companies that have adequate capacity to be able to deliver to the local, local solutions to local companies.
Do you think we can get to the point where we can use the local entities that we have without them having to partner with international companies? Because I'm thinking, okay, but you will answer this question for me maybe a bit later on. But I'm thinking that the more localized things are, the more safer they would be in our own hands. So can we get to that point where we build enough for us to be able to use what we have within the continent for our own systems and for our own banks?
I totally agree. And that has always been my goal and my dream, that one day we as Africa, or Kenya to be specific, are going to have adequate capacity to build as many solutions in-house as possible. And as I've just mentioned, most local consumers, enterprise consumers, would wish that was true. The reason being, a Kenyan company or an African company builds a solution from scratch, having an understanding of the context within which that system is to be utilized. The reason being that if you look at the many challenges that we've been facing as local consumers of foreign products has been, by the time that foreign product is qualified to go into production, a lot of customization has to happen. Let me give you an example of the auto industry. Most of the sports cars we have today come from the European market. And if you look at even the infrastructure in Europe, is different from the infrastructure in Africa. So you'd want a car that, though is a sports car, can easily maneuver the off-road terrain.
Yeah.
Now, the same applies to the IT systems we have, because we as Africa, we have a unique set of problems. And we need a mind that understands the context of these problems while designing and developing these systems. So I do strongly believe that in the next few years, we are going to have local companies that will be mature enough to provide such massive systems. And that's what most of the enterprise consumers are waiting for.
Okay, it's good to know that there's some hope for us here. But now, in terms of like the risks, because obviously there are risks that come with this, and I know you've studied these risks. What would you say are the fastest growing risks in our economy today, in the financial systems?
One of the biggest risks that has been a serious concern to most African markets has been the integrity of our financial systems.
Okay.
Because we are still in the growing stage compared to the developed world in terms of putting in place adequate controls to manage movement of money. Malicious actors have taken advantage of the weaknesses that we have had within our financial systems to be able to move illicit or illegal funds through these systems. But even so, a lot of work is being done. We have a body called AFTF, the Financial Action Task Force, that monitors the integrity of financial systems across the globe. That has been one of the serious concerns that we have had as a continent. But at the same time, another concern that we have had is what I've just mentioned. Most of the products that we use happen to be products that were designed for other markets, but not African markets. And so there is a gap between the expectations of an African consumer and what is actually being provided. And that pushes most of the solution providers on this continent to try as much as possible to every other time be customizing solutions whenever they are working in partnership with foreign entities to be able to address the needs that are needed or that are being faced by the African consumer. So there's so many other issues that we are facing as a continent. But I think lastly, I would equally just mention something to do with data. Because most of these systems that are being built in other markets are meant to manage data that is not African. And to just be specific, talking about artificial intelligence that largely lands on data through machine learning algorithms. So if we have a large language model that is being deployed by a Kenyan insurance company to manage fraud in Kenya, yet this product was trained in the Philippines or trained in the US on data that was largely that of the US citizens or Philippines. The chances of this algorithm not being able to successfully carry out its mandate are very high. So we have had those issues over time, but I'm glad to know that we've had a number of companies that have identified those issues and are working around the clock to ensure that we are able to have our own solutions for our own market.
So then, as much as a bank has good technology, can it still be at risk?
A bank, just like any other entity that handles finances, is always at risk. Because, to just mention about cybersecurity, there are reasons that may push someone to become malicious in the cyberspace or to become a hacker. And I'm talking about the non-ethical hackers.
Mm-hmm.
And the major interest has always been, is there a possibility of me accessing money in this system? Of course, some of them could be having other reasons, but the primary reason as to why most of them end up doing this, they want to identify weak systems or controls in systems and see how they can be able to pilferage or access funds illegally through these systems. And so, just to answer your question, the truth is that we have those concerns, especially within the financial system. And if for most of these cyber actors, their main attraction is towards finances, then of course, any entity handling money for customers will always be a serious target for them and always be at high risk and has to always be at high alert at all times.
So how are these risks mitigated or prevented? Because obviously we want to fix the risk before it actually comes to us. What are the ways that these are mitigated?
What works best for risk management is every organization to cultivate what is called a very robust enterprise risk management culture.
Mm-hmm.
It has always been said that no matter how strong and futuristic your strategy is, culture eats strategy for breakfast. Mm. And I've seen most financial institutions making a mistake of overworking when it comes to working on the strategic plan, both in the short, medium to long term, but not working on the company culture, especially around risk management. So any futuristic strategic plan should always factor in a very strong enterprise risk management mechanism. And how risk operates is that, first of all, the organization creates or develops the objectives they need. And then in the process of them achieving those objectives, they have to identify what could go wrong. And that's what you call the risk. in the long term or the short term. Having identified what could go wrong or the risk matrix for the entire organization, then they have to ask themselves, what measures can we put in place to ensure that we are able to take care of this risk should it materialize? Because risk is always measured from two angles. Number one, the probability of it occurring. But number two, the magnitude of its impact should it mature. So having put together the objectives you need to meet and having identified what could go wrong, which is the risk register or risk matrix for an organization, you equally need to put in place the controls that are meant to take care of these risks should they mature in the long term. So once you take care of those three, and every organization has got those three layers of defense. The first layer of defense, which is general management, takes care of the strategic plan. The second layer of defense is the risk and compliance team. And then the third line of defense is the internal and the external audit teams that now manage controls.
Okay. Wow. Okay. So, to what extent would you say then financial systems are about trust? Because I've seen you speak about, for example, a company like Safaricom and about how a lot of what they build on is trust. And obviously, they have the systems as well. So, how important is trust when you're building a financial system?
Just like the way things are between friends, where trust happens to be the most valuable currency, the same applies to the consumers of products and the providers of those products in any market, including the providers of financial products. So, as we just mentioned, take an example of Safaricom. Why has it grown in leaps and bounds since we had M-Pesa come into play in the year 2007, 2008? It is that over time, consumers have learned that this entity is able to take care of our interests and to take care of what we have stored or the value we've stored with them, which is, of course, money. And so the same applies to even provision of IT systems as a supplier or as a vendor. And there's what we call zero trust in the cyberspace. We have what we call the role-based access control when it comes to managing access to any IT solution. And the principle behind zero trust is never trust anybody until they prove beyond any reasonable doubt that they are who they claim to be.
Wow.
And we have what we call the AAA principle, where the first layer of managing the control around access to a system is you have to first of all allow them to authenticate, meaning that you want to prove that I am the person who professes to be the owner of this account. Then number two, having given them access, you go to authorization. Now that you've given them access to the system, how much are they able to do within that system? What number of privileges do they have? That's authorization. Then having had authorization, what are they going to do with that privilege? That is accounting, meaning that you are able to log and monitor all the operations they're doing end to end from the time they log into the system to the time they log out of the system. But at the end of the day, the most important thing is I need to know that me as a consumer of a product and you as a provider of the product, what connects the two of us and what we consider as the most valuable currency that we're trading with is trust, which takes a lot of time to build, but a very short period of time to be broken.
Yeah. I'm starting to understand why people keep their money under their mattress, because it feels like there's so much risk that comes into this whole financial systems and everything that we build around there. But just quickly, I want to touch on Kenya specifically. We use M-Pesa a lot. It's our main avenue of paying for a lot of people, actually. There's Airtel money, but I don't think it has as much growth as Safaricom has at this point in time. Is that a risk for an economy to depend on like one digital avenue?
It is a risk.
Okay.
Because within my career journey, there's a time I've worked as a risk manager. And there's what we call the concentration risk, where we have a single point of failure. Let me give you an example. Within your house, if you've got only one line for power, what happens when somebody cuts that line?
It's gone.
You're going to stay in darkness.
Yeah.
And that's why you realize that most economies have what are called redundancy within their systems, so that should one reliable channel fail, the other channels can pick up as fast as possible. In Kenya's context, we've had other players that have tried to try and compete with Safaricom. Unfortunately, they have been as successful. However, it is very healthy for any economy to have healthy competition, in that should one channel fail, you'll always have other backups to ensure that business goes on without there being adverse impact to the economy. So the truth is that yes, Safaricom has done its part. It has gained traction in Kenya's economy and has earned the trust of most Kenyans. And at the same time, it has allowed most customers to both have a sense of ownership of Safaricom as a brand, but at the same time to have a sense of belonging. And because of that, it has competed very well. But even so, it controlling 97% of mobile money transfers in this country, to me, from a risk point of view, introduces to our financial system what I call a single point of failure, which is concentration risk. And the only way the country can manage that is to create adequate space for other players to compete successfully with Safaricom and be able to introduce other channels that will run the economy should, God forbid, at any point in time, M-Pesa face technical hitches for long periods of time.
So would you say that now if M-Pesa, God forbid, goes down, Airtel would be the one that manages that or like takes up the mantle?
I wish it were possible for that to happen, and I look forward to a day when that's going to be possible.
Okay.
But even so, as things stand, me as a risk manager, I would confidently say that as a country, we are facing a very serious concentration risk issue with the way we as a country are relying on a single mobile money provider to run a lot of. Actually, the whole of last year, Safaricom M-Pesa moved close to 4 times Kenya's gross domestic product in terms of the cash flow in Kenya's economy. That is how deeply ingrained that product is. And that's why the government tries as much as possible to be in control of how such an entity runs, because at the end of the day, it ends up being a very key risk area for the entire economy.
Okay. Seems there's a lot of risk in our financial systems. Hopefully we can mitigate them more. But just as we close, I want to ask you one question, which is in the next 5 years, what growth do you see happening in the financial technology sector, and what risk do you think is also fast growing in the next 5 years that we should be looking out for?
Just like the extra time minutes given to a football match, a lot can happen that can change the results. So within Kenya's financial system, a lot is going to change within the next 5 years. But what I'm very much sure of is that there's going to be a lot of shift towards adoption of RegTech, in that regulators are going to push a lot into the adoption of tools to enable them manage compliance and risk management across the industry, but at the same time to push the entities to comply through the same solutions. But at the same time, there's going to be a lot of adoption of data and machine intelligence and artificial intelligence products and tools in the operations of this industry, as you have seen already happening. And so I believe that most of the entities are going to move into this space because Kenya's financial system happens to be very rich in the amount of data we have, but we haven't made adequate use of it. And I think as things stand in the world today, AI is proving to be a very big consumer of data to be able to operate. So to optimize value from the data that we have within this space, we are going to be having a lot of adoption of machine intelligence and artificial intelligence products within that space. But lastly, among other many things, is that we are going to see a lot of adoption of virtual products. And that's why of late you've seen the country enacting the Virtual Asset Service Providers Act. And in the next few weeks, we'll see the adoption of the Virtual Asset Service Providers regulations. So things to do with the cryptocurrencies, especially the stable coins. Because the year ending June of 2024, Kenyans had remitted 426 billion Kenyan shillings through stable coins. You haven't factored in so many other cryptocurrencies. That's why the country is pushing regulation to ensure that we have a lot of adoption. So I think we are going to see many things play out in that space, among the many other things that are going to happen, because we are highly dynamic as a country.
And what are some risks that you see are there risks that come with that regulatory system, or are there other risks that could come up even more in the next 5 years?
Other risks will keep on emerging, coming onto the scene, because the more we push into new technologies, the more malicious actors continue identifying some of the novel techniques they can use to be able to outdo regulators and the controls that have been put in place by financial players. So I think the area around anti-money laundering and combating financing of terrorism and combating proliferation financing are going to be very key concerns as we go ahead. But of course, issues to do with data leakage and data management and data exposure illegal are going to also occur. And that's why as a country we have the Data Protection Act and the regulations to enable those things to happen. But I believe that those are some of the risks that we stand to face as a country. But there are so many things to happen, but I believe that equally those areas need to be addressed. How it is going to be managed, how it's going to be processed, but at the same time, how are we going to control the flow of cash, especially illicit flow of cash through our economy?
So one of our biggest risks are our fellow humans. Wow. Okay. Well, I think we're going to close the episode there. Thank you so much, Rockfella, for your insight into the financial technology world. I think we pulled so much out of you, and we are so grateful that you chose to be with us today. And for our listeners, you've been listening to The African Stack, powered by DataWise Africa. Thank you for tuning in, and see you next time.